branch that you have, which is selling the goods on your behalf, that branch does not maintain accounts of its own. All the records of the branch, every time you as a head office, you are transacting with your branch, those records are maintained at the head office. Those records are maintained at the head office. So when it comes to dependent branches, the branch does not keep its own books of accounts. No. All the transactions of the branch are recorded at the head office. All the transactions of the branch are recorded at the head office. So that's the main feature of dependent branches. That's the main feature of dependent branches, in the sense that they don't keep the records of their own. No, all the records are maintained at the head office. So we want to look at what are some of the records, what are some of the accounts you as a head office, you keep on behalf of your branch. What are some of the accounts that you keep every time you're transacting with your branch? Which records, which accounts do you normally maintain? Which accounts do you normally maintain? One of the accounts that you normally maintain as a head office on behalf of the branch is an account we normally call branch stock account. That's one of the accounts you normally keep on behalf of the branch. Another account you normally keep on behalf of the branch is an account we call branch markup account. Is another account we call branch markup account. This account called branch markup, sometimes it's also called branch adjustment account. It's also called branch adjustment account. So some books would normally call it branch adjustment account. The other account you keep on behalf of your branch is an account we shall be calling goods sent to branch. Goods sent to branch. Another account you may keep on behalf of your branch is the account called branch debtors. So I want to go through the accounting entries. I want to go through the... Okay, I continue. So these are the accounts that a head office will keep on behalf of their branch. So we want to look at what is the purpose of each of these accounts and how do you go recording the transactions of each branch. Now, normally, every time the head office would send goods to the branch, the head office normally would send the goods to the branch, at what we call the selling price, or what we shall be calling the invoice price. Most head office normally send the goods to the branch at what we call the invoice price, at an invoice price or selling price of the goods. Now, normally, this account called branch stock account, this account is normally maintained at selling price or at an invoice price. That account is normally maintained at cost per selling price or what we call the invoice price. Now, the purpose of this account, we say this account normally acts as a control account. It normally acts as a control account for the goods with the branch. Every time I'm selling goods to the branch, it's like I'm charging them. Every time they return the goods to the head office, then I reduce what they owe me. Meaning, therefore, this account, we normally consider it as a control account for the goods with the branch, Don't forget, it is the head office that is maintaining this record. It's the head office that is maintaining this record. So they would want to know, whatever the branch is, whether the branch is doing the right thing or is not doing the right thing. So they will keep an account called branch stock account, which I have said is a control account. It acts as a control account for the goods with the branch. Therefore, it means by the end of the year, after we have entered the transactions in this account, by the end of the year, the head office will now come and balance this account. They will calculate the balance carried down and find out what that balance is. Whatever the balance carried down is in this account, whatever the balance carried down is in this account, that balance is considered. The balance in this account is considered as the closing stock of the branch. What is the branch having as their closing stock? So by the end of the year, let us assume you find a balance of 2 million. By the end of the year, let us assume you find a balance of 2 million. It means, according to you as a head office, your branch should be having a closing stock of 2 million. So if you find out from them what is their value of their closing stock, and they tell you their closing stock is worth 2 million at selling price, then you know the branch is doing the right thing. Then you know the branch is doing the right thing. So we are saying this account is considered as a control account in the sense that it is helping us to know whether the branch is doing the right thing or not. Now, the closing balance in this account, we are saying is considered, the closing balance is considered as the closing stock of the branch, the closing stock of the branch. If by end of last year, the branch was still remaining with some goods, then it means by the beginning of this year, we shall begin with a new balance. We shall begin with a new balance. And that is the balance we are calling the opening balance, the opening balance. So if there is an opening stock by the beginning of the year, that opening stock by the beginning of the year, we shall be bringing it down. So the opening balance in this account normally represents the opening stock of the branch, again at selling price, while the closing balance in this account represents the closing stock of the branch at selling price. So that is the purpose of that account, which we are calling branch stock account. It acts as a control account. We shall discuss the other entries that are involved in that account, but for now, I just want to explain the purpose of each of these accounts. Now, when it comes to branch markup, every time I'm sending goods to the branch, I am charging them. Don't forget, I am charging them at invoice price. Meaning, as a head office, there's a profit you are making. There's a profit you are making when you are trading with your branch, because you are sending goods to them and you are charging them at selling price or at an invoice price. Meaning, there's a profit you are making when you are trading with your branch. So this account, which we are calling branch markup, this account, we normally use it to determine the gross profit on trading with the branch. So every time you are selling goods to the branch, it's like you are selling to them, meaning you need to know what is the profit you as a head office you made every time you transact with your branch. So this account called branch markup account, we normally use it to determine the gross profit on trading with the branch. In other words, we consider the branch markup, we consider it as a trading account. We normally consider it effectively as a trading account. Of course, you know the purpose of a trading account is to determine the gross profit on trading. So every time I'm sending goods to my branch, it's like I'm trading with them. I want to know as a head office how much profit I made when I was sending the goods to the branch. And so we use it to determine the gross profit on trading with the branch. Now, this opening stock that we have discussed here, that opening stock that we have discussed there, don't forget it is at a selling price. And so if the goods had cost maybe 3 million and I invoiced the branch at 3.5 million, and by end of last year, the branch had not sold the goods, then automatically our opening stock of the branch will be worth 3.5 million. But remember, those goods costed me 3 million. I'm using as an illustration of 3 million. But I charged the branch 3.5 million by end of last year, and by end of last year, they had not finished selling them. So we are bringing down an opening stock of the branch at 3.5 million, which is the invoice price or the selling price. In this 3.5 million, because the branch had not sold the goods by end of last year, then it means you as a head office, there is a profit you have not yet earned. There is a profit you have not yet earned. That profit out of this amount that you have not earned by the beginning of the year, that profit is what we call the unrealized profit. So normally you have to calculate the opening balance or the unrealized profit on the opening stock. Whatever is the unrealized profit on the opening stock, that balance should be brought down in the branch markup account, should be brought down in the branch markup account, whatever it is. So coming back to the branch markup, we can say that the opening balance in the branch markup, normally represents the unrealized profit on the opening stock, represents the unrealized profit on the opening stock. Then again, because the closing stock has remained, because by the end of the year the branch has not sold goods worth 2 million, for instance, then it means that closing stock again has an element of unrealized profit. Whatever is the profit loading on this closing stock, you need to calculate it and then you consider it as your unrealized profit. So we shall be calculating the balance of the unrealized profit and carrying it down in the branch markup account, So that is how we deal with the branch. So we are saying the branch markup account is effectively a trading account. Don't forget that, in the sense that we normally use it to determine the gross profit on trading with the branch. Once we have entered all the transactions in that account, we shall be getting the balancing figure in this account, which is normally on the debit side, and that balancing figure will be representing what we are calling the gross profit on trading with the branch, So that's generally, in short, how we use the branch markup account. We use it to determine the gross profit on trading with the branch, and we have said the opening balance in this account represents the unrealized profit on the opening stock, while the closing balance in this account represents the unrealized profit on the closing stock. Then the other account we normally maintain on behalf of the branch is the account called goods sent to branch. And for now, I just want to say we normally maintain this account at cost price. We shall discuss in detail the other entries that normally come here. But the point is, all the entries that come here, all the figures that come here should be at cost. Later we shall discuss which entries will come there. The other account you normally maintain on behalf of the branch is the account of debtors. Of course, when the branch sells goods on credit, they will tell you, you enter there. When you receive cash from debtors, you enter it there. We shall discuss them in a short while. So we are now ideally through with the major accounts that you as a head office, you keep on behalf of the branch. The first one is the branch stock, which we have said is considered as a control account. It acts as a control account for the stock with the branch. The other key important point we have said is that the opening balance in this account represents the opening stock of the branch at selling price or at an invoice price, while the closing balance in this account represents the closing stock of the branch at selling price. That is it for now. Then the branch markup, we have said it's effectively a trading account used to determine the gross profit on trading. I have said some questions would require you to open a branch adjustment account. We know it's called branch markup, but some books will still call it branch adjustment account. Now, we can now go on and discuss the accounting entries now. We can now go on and discuss the accounting entries that are normally used when you are dealing with the books of the branch, when you are dealing with the entries for the branch. So let me go through the accounting entries. So we are assuming first is an opening stock. We are assuming you have brought it down. So I want to go through the accounting entries that are normally entered every time you deal with a branch. Now, don't forget, I've said all the records are maintained by the head office. It is you, the head office, who keeps the records on behalf of the branch. That's one of the main features of dependent branches. The other feature is that you as a head office, you pay for the expenses of the branch, and the branch also, normally they remit the cash. Once they sell the goods, they remit the cash to the head office on a daily basis. Now, let's start. Number one, with the goods that you have sent to your branch, every time you send goods to the branch, let us assume you have sent goods with an invoice price of 5.5 million, but they costed you 5 million. So with the goods sent to branch, you debit the branch to account at invoice price. You debit the branch to account at invoice price with goods sent, and you credit goods sent to branch at cost price, and you credit goods sent to branch at cost price, which I'm assuming is 5 million. And with the profit loading on the goods sent to the branch, with the profit loading on the goods sent to the branch, you credit the branch markup account. That is the first entry, which says with goods sent to branch, you debit branch stock account at invoice price, credit goods sent to branch at cost price, and you credit branch markup with the profit loading. That's number one. Number two, assuming for whatever reason, the branch returned some of the goods to the head office. Maybe the branch did not need all of this, or some were not the type the branch needed, so they returned some goods. Let us assume, for purpose of illustration, they returned goods with an invoice price of 1 million. I'm assuming the question tells you goods with an invoice price of 1 million were returned to the head office. So entry number two is with goods returned by the branch. With goods returned by the branch, of course, you reverse this entry. Don't forget, we have just sent goods to the branch. Now the branch is returning. So reverse that entry. How? By debiting goods sent to branch at cost price, by debiting goods sent to branch at cost price with any returns. For now, let me assume the cost is 0.8 million for purpose of illustration. With goods returned by the branch, we are saying you debit branch a goods sent to branch at cost price, you debit branch markup with the profit loading, you debit branch markup with the profit loading, which I'm assuming is 0.2 million, and you credit branch stock, and you credit branch stock at selling price, and you credit branch stock at selling price, which is 1 million for now, which is 1 million for now. So that's our entry number two, which says when the branch returns goods, with goods returned by the branch, you debit branch a goods sent to branch at cost price, you debit branch markup with the profit loading, and you credit branch stock at selling price. That's number two. Number three, now that we have sent goods to the branch would start selling. Whatever they sell, the branch will tell us as the head office. If they sell the goods by cash, therefore we are saying with any cash sales, we as a head office, we shall receive that cash. We shall debit cash and we shall credit branch stock. So with any cash sales, you debit cash and you credit branch stock. Why are we crediting branch stock? Because the branch has already sold the goods, and therefore by the end of the year, we shall not ask the branch to account for those goods, or by the end of the month, whichever the period you normally be concerned, we shall not ask them to account for the goods. Now that the branch has sold them, remove them from the control account, because by the end of the year, the branch will not account for them. Now, what if the branch sold the goods on credit? So we are saying on goods sold on credit, with any credit sales by the branch, you debit debtors with any credit sales, and you credit branch stock account, with any credit sales. So that's our entry number three, which says with goods sold by the branch. If they are sold by cash, we have said you debit cash, you credit branch stock. If they are sold on credit, debit debtors, credit branch stock. So either way, you must credit branch stock. So that entry number four says with number three, that entry says with goods sold by the branch, you debit cash or you debit debtors and you credit branch stock. That's our entry number 3. Number 4, now that we have sold the goods to the branch or to the debtors, now that the branch has sold goods to the debtors on credit, if we are receiving any cash from debtors, with cash received from debtors, of course, just like normal debtors, you normally debit cash and you credit debtors. With any cash received from debtors, that's our entry number 4. You debit a bank or cash and you credit debtors and you credit debtors. That's our entry number 4. Number 5, assuming there is a discount that we allow to the debtors. With any discount allowed to debtors, you will debit discount allowed, just like any other debtor, you will debit discount allowed and you credit debtors and you credit debtors. That's our entry number 4. That's our entry number 5. With any discount allowed to debtors, you debit debtors and you credit, and you debit discount allowed and you credit debtors. The next entry is with any debtors being written off or bad debt written off. With any bad debt written off, of course, you will debit bad debts and you credit debtors. You debit bad debts and you credit debtors. That's our next entry. That with any bad debts written off from debtors, you debit bad debts and you credit debtors. That's our next entry. The next one is if the debtors return the goods to the branch. We as a branch, the branch one time sold the goods to a debtor. Now, the debtor, for whatever reason, is returning the goods to the branch. What entry do you think we shall pass with goods returned by debtors to the branch? Don't forget that the branch one time sold the goods on credit to the debtor. So now that the debtor is returning to the branch, then it means when the debtor returns the goods to the branch, of course, we reverse the entry we made when the goods were sent to the branch. So get the point there. We recorded by saying every time the branch sold, when we send the goods to the branch, when we send the goods to the branch, or when the debtor sold the goods, when the branch sold the goods to the debtor, when the branch sold the goods to the debtor, we debited debtors, we credited branch stock. Don't forget, when the branch sold the goods to the debtor, we debited our debtors, we credited branch stock. Now that the debtor is returning them to the branch, then I'm saying reverse the other entry, the initial entry. So how do you reverse it? By crediting debtors, and of course you debit branch stock accounts. So with any returns by debtors, we are saying you debit branch stock and you credit debtors and you credit debtors. That is to reverse the entry we made when the branch sold the goods to the debtor, when the branch sold the goods to the debtor. That's our next entry. Next one we go to now. Assuming for whatever reason, this debtor, instead of returning the goods to the branch, the debtor decided to return them direct to the head office. We want to discuss the next entry, that what if the branch debtor returns the goods direct to the head office? Don't forget, the goods were sold by the branch to the debtor. But for whatever reason, the branch or the debtor decided to return the goods to the head office. How do you record that transaction? Now, there are two ways of recording that transaction. And the first approach is, first you can assume, one method that you can use to record this transaction is first to assume that the debtor returned the goods to the branch. Then you take it that the branch is now the one returning them to the head office. That's one way. Where we are saying, if a data returns goods to the head office, then there are two ways or two methods you can use to record this transaction. First, you can assume let the data return. We assume that the data returned the goods to the branch, then the branch returned them to the head office. Let me record that transaction first. Let us assume that the data returned the goods to the head office, and we now want to assume, suppose we take it that he returned them to the branch. What entry shall we pass? Of course, we have just seen a short while ago that when our data returns goods to the branch, we said you credit data. Let us assume the value was 1 million. You credit data and you debit branch stock, and you come and say your returns by datas 1 million. Just like this other one we dealt with. That way, we assumed that the data returned them to the branch. Now the goods are at the branch. Then let us now take the second assumption that the branch now took the goods and returned them to the head office. Of course, you know we have discussed this. When a branch returns goods to the head office, what was the accounting entry? It's the same one we want to apply. We saw when a branch returns goods to the head office, you reverse the entry you made when you were sending them to the branch. You remember, when you were sending them to the branch, we debited branch stock. You remember, we credited goods sent to branch at cost price, and we credited branch markup with a profit loading. That was the entry we made when we were sending goods to the branch. Now that the branch is assumed to be returning to the head office, then we reverse that entry of sending to the branch. So automatically it would mean with goods returned by the branch to the head office, we debit branch goods sent to branch, we debit branch goods sent to branch again at cost price, which we want to assume is 800 for purpose of illustration. And we debit branch markup with a profit loading, and we debit branch markup with the profit loading. That is what we want to assume as 200,000. This is returns to head office, it's 200,000. This was returns to head office, and this one we can say returns or came. So we are saying you debit branch markup with the profit loading, you debit goods sent to branch at cost price, and you credit branch markup and you credit branch stock at selling price. This is returns to head office. That is 1 million. So that is the entry if we assume the recording of where we assume that, let us assume the data returned the bank goods to the branch. I have said when you assume that approach, then the data returns the goods to the branch. We had to credit data, and we had to debit branch stock. That's what you know with any goods returned by datas. Then, now that we are assuming again goods are at the branch, now we take it, the branch is the one that returned them to the head office. The branch is the one that returned them to the head office. How did we record that? We have just said you debit goods sent to branch at cost price, you debit branch markup at selling price, with a profit loading, and you credit branch stock at selling price, at selling price. Now, there's another approach. We have looked at the longer way of recording it. We have looked at the longer way of recording goods returned by datas direct to the head office. But the shortcut approach, which I want us to be using, is this. Now, if you look at what we have done in the branch stock, from what we have done when the data return goods to the head office directly, we saw we are still debiting the branch stock by 1 million. We are still crediting the branch stock by 1 million. And therefore, it means when we record this transaction twice, that transaction effectively, it has no effect on the branch stock account. It has no effect on the branch stock. Why? Because we are debiting branch stock with the same amount of 1 million, and we are crediting branch stock with the same amount of 1 million. So it will not have any effect on the balance that we shall carry down here. It will have no effect. Meaning that as a company, whenever a data returns goes to the branch, to the head office, whenever data returns goes direct to the head office, it is possible that you can avoid recording that transaction through the branch stock. Why? Because you are still debiting the account and crediting the account to the same amount. So you can avoid this account. If we avoid this, remember that goods that were returned to the branch are goods that were returned by a data to the head office. We were assuming they had an invoice price of 1 million. So I hope you can see the other entries that are remaining when we recorded that transaction twice. The other entries that are remaining are this one, and this one. So in summary, we shall be saying, if we use the one way of recording, in case a data returns goods to the head office, then the one way of recording it is to just come and debit goods sent to branch at cost price, is to come and debit branch markup with the profit loading, and you credit data with the selling price. So that's one way, that's how you record it once. That's how you record the transaction once. Instead of going through this account called branch stock account, instead of going through the account called branch account, you can record that transaction once. How? By debiting goods sent to branch at cost price, you debit branch markup with the profit loading, and you credit data at selling price. That is in case a data returns goods direct to the head office. So that is it for goods returned by data direct to the head office. That is it for goods returned by data to the head office. So our next entry that we want to discuss is this. At the branch, there could be what we call loss of stock. Loss of stock. From your previous classes, I hope you know that there are different types of loss of stock. There is what we call a normal loss of stock, and there is what we call abnormal loss of stock. Abnormal loss. So assuming there was a loss of stock at the branch, you need to know that abnormal loss, that loss, was it a normal loss or was it an abnormal loss? So let us assume the loss was a normal loss of stock, whatever the value the question will give you. So how do you record normal loss of stock? Of course, you know normal loss of stock is the loss that is expected, loss that is expected. So if it's a loss that is expected, which is a normal loss, then how do you record? The double entry is, with any normal loss of stock, you debit branch markup account, with the normal loss of stock, whatever it is. Let us assume 200,000. That was the normal selling price of the normal loss, and you credit branch stock, Why do we credit branch stock? Because again, you will not ask the branch to account for the goods by the end of the year, so you remove them from the control account. So that is the double entry for normal loss of stock. But with any normal loss of stock, you debit branch markup with the selling price of the normal loss, and you credit branch stock at selling price. But if it was an abnormal loss of stock, maybe goods are stolen at the branch. That's not normal. There was a stock theft at the branch, and therefore that's not normal. So whatever is the amount of the abnormal loss, for now, let us assume again is 200,000. From this 200,000, you will be required to find out how much of that 200,000 is the cost price of the goods out of 200,000, and how much of the 200,000 is the profit loading. Why? Because if goods are stolen at the branch, then you as a head office, you need to charge that branch. let them account for the loss or take over the loss of that stock. For normal loss, you don't charge them because it's a loss that was expected. But for any abnormal loss, we need to charge that branch. We need to charge that branch. That's why we are saying with abnormal loss of stock, e.g. stock theft, we normally separate the selling price. How much of it is the cost price? How much of it is the profit loading? For now, again, let me assume that out of 200, maybe the cost price of the abnormal loss is 150, and maybe the profit loading is 50,000. So what should be the double entry? The double entry is with any abnormal loss of stock, then with the cost price of the abnormal loss, you charge the branch by debiting the branch P&L. You charge them in their profit and loss or in their income statement. Let them take over that loss. So let the branch suffer that loss. You charge them in their P&L account. And with the profit loading, which in our case is 50,000, that is the one you debit in the branch markup. So with any abnormal loss of stock, with the profit loading, we are saying you debit the branch markup, and with the cost price, we are saying you debit branch P&L, and with the selling price of the abnormal loss, you remove them again from the control account, because again, by the end of the year, the branch will not account them as part of their closing stock. No, and the amount is 150, not 200,000 again. So that's how we deal with abnormal loss of stock. So if it's a normal loss, I have said, if it's a normal loss, you don't separate the selling price between the cost and the profit. No. So for the normal loss, you suffer all of it, you as head office, by debiting the branch markup with the normal selling price of the normal loss, and you credit branch stock. And if it's an abnormal loss, that's what we are trying to emphasize, then that abnormal loss of stock, you split it. How much of it is the cost price? How much of it is the profit loading? And with the cost price, we have said you debit the branch P&L, and with the profit loading, you debit the branch markup, and the selling price of the abnormal loss, you credit branch stock account. You credit branch stock account. That's the entry for the loss of stock, whether normal loss or abnormal loss. We go to the next entry. Now, one time as a head office, when you are selling goods to the branch, you charge them 5.5 million. You debited the branch stock at 5.5. The goods had a cost of 5 million. You credited branch stock, a good sent to branch at 5 million, and you credited branch markup with a profit loading of 500,000. So these goods costed 5 million. We are developing now the next entry. These goods costed 5 million. But instead of charging the branch 5.6 million, you as a head office, you charge the branch 5 million. 5.5. You charge the branch 5.5. So you debited branch stock at 5.5. You credited goods sent to branch at 5 million, and you credited branch markup with a profit loading of 500. Later you realize you should have not charged them 5.5, you should have charged them 5.6, meaning you charged them less than you ought to have charged them. This is what we now call, with any increase in selling price, we also refer to this as markup in price. So with any markup in price, then we want to increase this amount of 5.5 and make it 5.6. We want to increase the amount to 5.5 and make it 5.6 million. Remember, the cost price has not been affected. The cost price still remained 5 million. The only thing is, instead of invoicing them at 5.5, you as head office, you invoiced your branch at instead of invoicing them at 5.6, you invoiced them at 5.5. So the cost will not be affected. What is affected is your profit. You as a head office. So we are saying with any markup in price, that's our next entry. With any markup in price, the double entry is you debit branch stock at what? With any increase in price, which in our case is 100,000, you debit branch stock. I hope you know the other entry we shall make. Of course, we shall credit branch markup because we undercasted our profit. So you come and say here markup. You come and say here markup, and the amount is 100,000. The amount is 100,000. So that's the double entry when there is any markup in price or when there is an increase in selling price. When there is an increase in selling price. So that's our entry for any markup in price. For any markup in price. The other way is, what if these goods had costed again 5 million? You were to charge them 5.4 million. You were to charge them 5.4 million. That's how you are to invoice the branch. But instead, you as a head office, you invoice them at 5.5. We are saying these goods costed 5 million. You were to charge the branch 5.4. That is how you are to invoice them. But instead, you charge them 5.5. So what double entry did you make? You debited branch stock with 5.5 million. You credited goods sent to branch at cost price 5 million. And you credited branch markup with a profit loading of 0.5 million. Later, you realize you should not have charged them 5.5. You should have charged them 5.4. Remember again, the cost of the goods have not been affected. What is affected is the profit loading. Instead of recognizing a profit of 0.4, you as a head office, you recognized a profit of 0.5 million. So how do you go about it? We normally call this kind of a scenario a decrease in selling price. We normally call it decrease in selling price, or we normally call it markdown in price. So if there's any markdown in price, what should be the double entry? The double entry is, remember this being a trading account, and you recognized a profit which was more than you should have recognized. Now we need to reduce that profit. So the double entry is you debit branch markup and you credit branch stock with any markdown in price, which for my case, I'm assuming 100,000. You debit branch markup to reduce your profit, and you credit branch stock, and you come and see here markdown. So that is the double entry for any markdown in price, Like if there's any decrease in selling price or any markdown in price, the double entry is you debit the branch markup and you credit branch stock, So that's the entry for any markdown in price. Now we go to the next entry. We are almost through. With the accounting entries. Now, before I mention the other one, once you are through with those many entries, there are about 12 so far that I've discussed. There are about 12 entries that I've discussed so far. Once you're through with those entries, the first thing to do is to balance the debtors account at the branch stock account. Go balance that account. I'm assuming you have entered all the transactions. Now go balance this account called branch stock. Get the balance carried down. Whatever the balance carried down, we say the balance in that account represents the closing stock of the branch at selling price. We say it represents the closing stock of the branch at selling price, which you remember we were assuming 2 million. Now, then I say if the closing stock of the branch is at 2 million, then, and this account is maintained at invoice price, then I say within this amount, there is an unrealized profit. So we say you calculate that unrealized profit on closing stock, and then we say you carry it down. So we come and say balance carry down. Whatever is the unrealized profit on closing stock, calculate it. The question will guide you what is the profit loading, whatever markup or margin, whatever it is, calculate that amount. Whatever it is, which for now I want to assume is 0.5 million, then with the profit loading, you come and cut down that amount. Once you are through with this account called branch stock, now you come to this account called branch markup. The next entry now says, with the balance in the branch markup account, which I hope you still remember we said we normally use the branch markup to help us determine the gross profit, So once you're through, there will be a balancing figure in this account, and that balancing figure is what we say will be considered as a gross profit on trading with the branch, and the balancing figure will normally be on this side. So you will debit the branch markup on the gross profit, you will debit the branch markup, and of course you credit branch P&L, Of course, you know gross profit is normally credited in the profit and loss. So the double entry is with the balance in the branch markup account, you debit branch markup and you credit branch P&L, That's our next entry. And then finally, number 15, we are number 14, I think so. We are saying once you're through with that, now you come and get the balance in the goods sent to branch. So with the balance in the goods sent to branch, you debit branch goods sent to branch, and you debit goods sent to branch, and you credit head office purchases. Normally the balance in this account is transferred to the head office purchases, So I've taken you through the accounting entries, to record for whatever transactions you as a head office you undertook with your branch. So let's go through them again. Then we develop the topic. The first one we say, when goods are sent to the branch, we say you debit branch stock at selling price, and you credit goods sent to branch at cost price, and we say you credit branch markup with the profit loading. That was the first one. The second one we say, when goods are returned by the branch, to the head office, we said you reverse that entry. How? We said you debit goods sent to branch at cost price, we debit branch markup with the profit loading, and we said you credit branch stock at selling price. That was our next entry. The next one we say, when goods are sold by the branch, whether by cash or on credit, if by cash, we said you debit cash and you credit branch stock. If goods are sold on credit, we say you debit branch debtors and you credit branch stock, That was our entry for sales. Then the other one we say, with cash received from debtors, we say you debit cash and you credit debtors. The other one was with discount allowed to debtors, we said you debit discount allowed and you credit debtors. The other one was with bad debts written off, we said you debit bad debts and you credit debtors. Then we also say, what if a debtor we have just sold goods to returns the goods to the branch? With goods returned by debtors to the branch, we said you reverse which entry? We say when goods are returned by a debtor to the branch, you reverse the entry you made when the branch sold them. When the branch sold them to the debtor, when the branch sold the goods to the debtor, you remember we debited debtor, we credited branch stock. Now that the branch has returned, we credit debtor, and we debit branch stock. With any goods returned by debtors, you debit branch stock, and we said you credit debtors. That was our entry next. The other one we say, what if a debtor now does not return goods to the branch? What if the debtor does not return the goods to the branch, but instead he returns them direct to the head office? We saw there were two ways, but we looked at a shortcut approach. Where we said you can record it once. And the one entry we said that you can use when a debtor returns goods to the head office is, we said you debit goods sent to branch at cost price. We said you debit branch markup with the profit loading, and we said you credit debtors, and you credit debtors at selling price. Don't forget, we say when a debtor returns goods direct to the head office, you can avoid going through this account. You remember, we said if you go through this account, you will debit the same amount, you will credit the same amount, and we said it has no effect on the overall entry. entry. From there now, we go to the next one. From there now, we go to the next one where we say, what if there is a loss of stock? What if there's a loss of stock? And we say, if it's a normal loss of stock, we say with the whole selling price with the loss of stock. With the normal loss of stock, we say you debit branch markup, and we say you credit branch stock with the normal loss of stock. Then we have said, what is an abnormal loss of stock? With an abnormal loss of stock, we say with the cost price of the abnormal loss. Don't forget, we say you debit branch P&L. We say you debit branch P&L, and we say we also debit branch markup with the profit loading of the abnormal loss. We debit branch markup with the profit loading of the abnormal loss. Then we say you credit branch stock with the selling price. We say you credit branch stock at selling price. That was the entry for normal loss. Then the other one was if there's a markdown in price or markup. We say if there's a markup in price, in other words, if there's an increase in selling price, we say you debit branch stock with any increase in selling price, and we say you credit branch markup and you credit branch markup if there's an increase in selling price, which we are calling it markup in price. What if there's a markdown in price? We have said if there's a markdown in price, we say you debit branch stock, a branch markup, and you credit branch stock if there's any markdown in price, which is the same as saying when there's a decrease in selling price, when there's a decrease in selling price. Then from there we say, once you're through with the transactions, the first account to close should be the account of the branch stock. Get the balance carried down. That balance carried down, we say, represents the closing stock of the branch at selling price. It represents the closing stock of the branch at selling price. Get the profit loading on that closing stock, that closing unrealized profit, we say, bring it down into this account, Once you enter that unrealized profit on closing stock in the account of the branch markup, we say there will be a balancing figure now. And that's the entry one to say, we say you record it. So the balancing figure in this account, we say represents the gross profit on trading with the branch. It represents the gross profit on trading with the branch, and therefore get it. Whatever is the gross profit or whatever is the balancing figure, we say you debit branch markup and you credit branch P&L and you credit branch P&L. Once you're through with that, then you come and close this account called branch goods sent to branch. And we say the balancing figure should go to the head office purchases account. How? By debiting the goods sent to branch account and you credit head office purchases account by crediting. Then of course you normally close the debtors account as normal by the end of the year by calculating the balance carried down in the branch debtors. Now, before we do an illustration for this, let me discuss one small thing. Then from there, we now do an illustration. Now, let us assume that as a head office, you have a branch in Nakuru. At the same time, you have another branch in Kisumu. One time, you instructed your Nakuru branch to send goods to Kisumu branch, and Nakuru branch decided to send goods whose invoice price it was ₦1,000,000 to Kisumu. So when the head office has several branches, it is possible that there could be what we call inter-branch transactions. Don't forget, we said when it comes to dependent branches, all the records are maintained by the head office. But you, as a head office, you instructed your Nakuru branch to send goods to Kisumu branch. So how do you, as a head office, record such a transaction? Not forgetting that Nakuru does not have any records of their own, Kisumu does not have any records of their own. It is you, the head office, who has the records, and you are the one maintaining these records. So whenever there is an inter-branch transaction, then you, as a head office, you first record as if this branch we are considering to be Nakuru, as if Nakuru branch returned the goods to the head office. You, as a head office, you record as if the Nakuru branch returned the goods to the head office. Then you, the head office, again, you record as if you sent them to your Kisumu branch. That's how you record that inter-branch transaction. So you record as if Nakuru branch returned the goods to the head office, then again the head office will record the goods as if they are sending them to Kisumu, as if they are sending them to Kisumu. So we want to look at how do you go recording that transaction. So you as a head office, in your books, which accounts will you debit, which accounts will you credit. So when you record as if Nakuru is returning them to the head office, so you take it like any other branch returning the goods to the head office. And of course, you know the double entry. When a branch returns goods to the head office, you obviously reverse which entry? You normally have to reverse the entry called goods sent to branch. And I do hope you remember we said when you send goods to the branch, we said you debit branch stock, we said you credit goods sent to branch, and we said you credit branch markup. Now that you are recording as if the branch is returning, then the entry to make now is when a branch returns goods to the head office, is you're recording like Nakuru is returning. So you will debit the account called goods sent to Nakuru branch. This time you have to specify which branch you're dealing with. So in your books as a head office, you will have an account called goods sent to Nakuru branch, goods sent to Nakuru branch, goods sent to Nakuru branch. This time, you will also have a branch stock account for Nakuru. You will also have another branch stock account for Kisumu. So when a branch, assuming it's Nakuru, returning the goods to the head office, you as a head office, you will debit goods sent to, Nakuru branch, debit goods sent to Nakuru branch at cost price, which I'm assuming is 800, because they were instructed to send goods with an invoice price of $1 million. So you will debit goods sent to Nakuru branch at cost price. They will also debit, you as an office, you will debit Nakuru branch markup account. You will have another account called Nakuru branch markup, because this time you have a Nakuru and you have Kisumu. So you will debit Nakuru branch markup account with a profit loading, which we are assuming to be 200, and you will credit the account called Nakuru. You will credit the account called Nakuru branch stock account, with that 1 million. So that way, you have recorded as if Nakuru has returned the goods to the head office. By debiting goods sent to Nakuru branch, you debit Nakuru branch markup account, and you credit Nakuru branch stock account. Then I've said, once the goods are in the head office, now record them again as if the head office is sending them to the other branch, which is Kisumu. So now let's record there, like the head office again is sending them to the Kisumu branch. So what entries will they make? Of course, you know, when you send goods to the branch, you as the head office, you normally debit branch to account. So this time, you will debit the account called Kisumu branch stock account. You will debit the account called Kisumu branch stock account with the invoice price, which is 1 million. You will credit Kisumu branch markup account. Of course, you will have another account for markup for Kisumu. So you will have credited Kisumu branch markup account with the profit loading, which we are assuming to be 200. And of course, you'll also credit goods sent to Kisumu branch with a cost price of 800. So that's how you record that transaction, that now you record as if the head office is sending them to Kisumu. You debit Kisumu branch stock account at invoice price, debit Kisumu branch stock account at invoice price, credit goods sent to Kisumu branch at cost price, and you credit Kisumu branch markup account with the profit loading. So normally, whenever you're given a question on branch accounts, normally there will be a part of the transaction which we are referring to as inter-branch transaction. But the key point is, whenever one branch goes to another branch, you as a head office, you record as if the first branch returned the goods to you. Then you as a head office, you took the goods and sent them to the second branch, you record them that way. So I think I've introduced you to all the concepts you need to know concerning dependent branches. Now we can do an illustration. Concerning the entries we have talked about. So there is an illustration question I want us to do. Now that we have gone through the accounting entries that one uses when dealing with dependent branches, where one deals with dependent branches. So let's go now and deal with that illustration question. So I want to read it. It says, X Limited has two branches, one at Kisumu and the other at Mombasa. The goods are invoiced to the branches at cost plus 50%. Branch remit all cash received to the head office, and all expenses are met by the head office. The following were particulars of each branch. So you're given a column for Kisumu, you're given a column for Mombasa. You're given the stock on 1st January 2007 at invoice price. You're given data on 1st January 2007. You're given goods invoiced to branches at cost price. You're given the cost price. You are given the sales at branch both by cash and on credit. Then you are given goods returned by branches. You are given the invoice price. You are given cash collected from debtors. You are given goods returned by debtors. Then you are given goods transferred from Mombasa to Kisumu. You are given the invoice price, of course. Then you are given stock, a shortage of stock at invoice price. It's only Kisumu that had a stock shortage. Then you are given discount allowed to debtors. Then you are given branch expenses. Then you are required to open branch stock, branch debtors, branch adjustment, and branch income statement. So let's open those accounts. The first account they are asking you to open is an account called branch stock. Remember, we have two branches. So we need to prepare our account in columnar form. Whereby each side of the account will have two columns, one for each branch. So we need to open an account called branch stock. The first branch is Kisumu. The other one is Mombasa. Kisumu, Mombasa. The other account they want us to open is branch markup. Branch markup. Let me squeeze it here. Let's call it branch markup. The other account, though they don't want us to open it, is a goods sent to branch. We can use it for the purpose of completing the double entry. Goods sent to branch. Normally it's not a long one. This is goods sent to branch. Again, we need a column for Kisumu, Mombasa. The other account they want us to open is an account for debtors. It's not long. This is debtors. Again, Kisumu, Mombasa. So let's start. They have given us the opening stock, so we bring down the balances by the beginning. We come and see the balance brought down. And they're giving us opening stock at invoice price. Kisumu has an opening stock of 93, while Mombasa has an opening stock of 156. You remember we said this account is maintained at invoice price or selling price. And because by end of last year, the branch had not sold the goods, then it means as a head office, we have an element of unrealized profit. And we say, whatever is the unrealized profit, you bring it down in the branch markup account. So we need to calculate out of that amount, how much is the unrealized profit? How much is the unrealized profit? They are telling us the policy of sending goods to the branch, is cost plus 50%. Cost plus 50%. I do hope you know from your previous accounting lessons or classes, even in section 1, when they say this is cost plus 50%, this is what we normally refer to as markup. I hope you still remember markup is GP or gross profit divided by cost. So our markup being 50%, in simple fraction, our markup is a half. This 93,000 is at selling price. So if I want to determine the profit loading out of this 93, there is no way you can take a half or 50% of this amount. Why? Because markup does not go with selling price. I hope you remember that. Markup goes with cost. And of course, you know, there is normally a relationship between what we call markup and margin. Of course, you know, margin is GP divided by selling price, or gross profit divided by selling price. Now that we have the selling price and we have the markup, of course, the examiner wanted you to convert this markup to margin. And so you needed the relationship between markup and margin. Of course, I know you know that when you're given a markup of a half, the margin of that company is a third. I hope you know the relationship between markup and margin, that how to convert markup and margin. That is something you must have done in section 1, financial accounting. Okay, now that we have converted our markup to margin, now I have the margin, now I have the selling price. The two go together. So if I want to know my profit loading here, I can simply take a third of the 93. So that being the margin, which is a third of 93, therefore becomes 31. And that becomes our unrealized profit on opening stock for Kisumu. We do the same for Mombasa. Mombasa had an opening stock of 156. Mombasa had an opening stock of 156, and therefore we need to know what is the profit loading in that amount. Not forgetting that being the selling price, we don't need the markup, we need the margin. Our margin is a third, so we divide that by 156 divided by 3, that gives me 52. So our unrealized profit on opening stock for Mombasa is 52. So we have brought down the opening balance, we have brought down the opening stock, and normally, get the point, the examiner will always give you the opening stock, but he will never remind you to deal with the unrealized profit. The examiner will normally give you the opening stock, but it's your responsibility to remember that if there's an opening stock, there must be an element of unrealized profit in that opening stock. Why? Because this opening stock is not at cost, but it is at selling price. It is at selling price. So we are through with the opening stock. We now go to the next one, and the next item in the question is debtors. We bring down the balance of debtors. That one, there is no problem. We come and bring down the balance of debtors, and our balance goes down for debtors. For debtors of Kisumu, there were 68,000, while the debtors of Mombasa were 87,000. That's all for the opening debtors. Next one, we are given goods sent to branches, or invoice to branches, and this time they are giving us at cost price. They are saying goods sent to branch Kisumu, their cost price was 340. You know, and we have said the double entry, when goods are sent to the branch, we say the debit branch stock account, we say the credit branch markup with a profit loading, you remember, and we say you credit goods sent to branch at cost price, and you credit goods sent to branch at cost price. Now that we are given the cost, we don't need the cost price for now, we need the selling price or the invoice price. So we come and say your goods sent. Of course, again, now we have the cost or 340. To get the selling price, of course, you know selling price is cost plus profit. So we need to know how much is the profit. Question is, again, to determine the profit, do I take a half of these 340 or do I take a third of 340 to get the profit? Not forgetting, we have been given the cost. So when you know the cost, you don't need the margin, instead you need the markup. So we were given the markup as a half or 50%, which is a half. So we take a half of 340, that comes to 170. 170 being the profit, I add it to the cost of 340, that gives me the selling price to be 510. 340 plus 170, that is 510. When we debit branch stock account at selling price, we credit goods sent to branch at cost price, and we come and see a branch stock. For Kisumu, it is 340,000, and we said you credit branch markup account with the profit loading, and you come and see your goods sent, and the profit loading is 170. We do the same for Mombasa. And Mombasa, we sent goods to them whose cost was 360. So if the cost again is now 360, we get the selling price by taking a half of that 360, which is 180. 180 being the profit, we add it to the cost, so 180 plus 360, that looks like 540. So the selling price of the goods sent to Mombasa is 540. So we debit branch stock at selling price. You remember, we said you credit goods sent to branch at cost price, which is 360, and you credit branch markup with the profit loading, and the profit loading being 180, we credit branch markup account. With the profit loading. That's all for that. Now we go to the next transaction, and the next one is about the sales. They are giving us cash sales. Kisumu cash sales were given us 250, 100, 250, 100. Of course, we say when goods are sold by cash, you debit cash and you credit branch stock. So we come and see your cash sales. Kisumu had cash sales of 250, 100, while Mombasa had cash sales of 350. The examiner is not asking us to open a cash account, but we are debiting cash, crediting branch stock. From there, we go to the next one, and the next one is credit sales. We know the double entry for credit sales is when goods are sold on credit, you debit debtors, you credit branch stock, and you come and debit debtors, and we say your sales. To Kisumu, or Kisumu branch, sold goods for 310,000, while Mombasa branch sold goods for 301,000. So we have debited debtors, let us credit branch stock, and we come and see your credit sales, just to make you remember credit sales. And the credit sales for Kisumu were 310, while the credit sales for Mombasa was 301. So we are through with the entry for credit sales. The other one is goods returned by debtors. Goods returned by debtors. I hope you remember we say when a debtor returns goods to the branch, goods returned by goods returned by branch. Goods returned by branch. When a branch returns goods to the head office, of course, we said you reverse which entry? We said when a branch returns goods to the head office, you reverse the entry you made when goods were sent to the branch. So here we said when goods are sent to the branch, you debit branch stock. We said you credit goods sent to branch, and we said you credit branch markup. Now that they are goods returned by branches, let's reverse that entry. So let us debit goods sent to branch at cost price and come and see the returns to head office. Kisumu branch returned goods worth 15 million and 15,000, and that is the selling price. That is the selling price. I hope you know 15,000 being the selling price, and I need to debit the branch, a good sent to branch at cost price. I need to determine the cost price. So if the selling price is 15,000, if I remove the profit out of the 15, I'll be left with the cost price. So to determine the cost price, I need to get the profit out of 15. So the point is, do I take a half of these 15 or do I take a third? Remembering that this 15 is the selling price, and therefore you don't need the markup. Of course, you need the margin. You need the margin. So our margin being a third, I take a third of 15, that gives me 5,000. 5,000 being the profit loading out of the 15, therefore it leaves me with a cost price of 10,000. So with the cost price, I debit the goods sent to branch at cost price, that's what we say. You debit branch markup, we say, with the profit loading, and you come and say returns to head office, and the amount is 5,000, and we say you credit branch stock, and we say you credit branch stock at selling price. To reverse that entry, we come and credit branch stock, and we say your returns to head office. It is only Kisumu that returns. Mombasa did not have any returns. So we are through with the entry for goods returned by branches. The double entry we have agreed is you debit goods sent to branch at cost price, debit goods sent to branch at cost price, debit branch markup with the profit loading, and we say you credit branch stock, at selling price. Next entry talks about cash collected from debtors. Cash collected from debtors, that's not a big deal. You know, with cash received from debtors, we say you debit cash and you credit debtors. So we come and see your cash received. From Kisumu customers, we received cash of 3 or 4,000, while from Mombasa customers, we received 298,000. We received 298,000. So that is the entry for cash collected from debtors. Next one, goods returned by debtors. Goods returned by debtors. Obvious, I hope you still remember. We say when goods are returned by debtors to the branch, of course you reverse which entry? We say you reverse the entry you made when goods were sold to the debtor. And of course, you can see when we sold the goods to the debtor, we debited debtors and we credited branch stock. Now that goods are being returned by debtors, we reverse that entry. How? By debiting branch stock, and we come and see the returns by debtors. And Kisumu customers returned goods worth 12,000. We debit branch stock at selling price, while Mombasa customers returned goods worth 15,000. So we are debiting branch stock, and we say you credit debtors, and you credit debtors. These are returns. Kisumu customers returned goods worth 12, while Mombasa customers returned goods worth 15,000. So that is all for that transaction. Next one, according to the list, goods